This video is brought to you by Seeking Alpha. If you use the link down below, you'll get it for just $99 for a year versus the normal $239 with the special Meet Kevin link down below. Hey everyone, Meet Kevin here. We've got three very important things to talk about in this video. Number one, we're going to talk about the consumer, which makes up over 70% of our economy. Consumer spending trends. Are they going to fall off a cliff? And then number two, why is consumer credit exploding? And then this is a big potential red flag for markets going forward. And what just happened with one of the key signals that the Federal Reserve looks at when it comes to hiking and crushing any life in our markets. Let's talk. But first, I want to mention I appreciate you being here. All right, let's get right into this. This is a Bank of America research piece. It shows that consumer spending is up about 7% year over year in July, roughly in line with June, so no large decline between June and July in summer spending. Total credit and debit card spend, making up about 20% of payments, was up about 8% year over year. And now a lot of this is probably due to inflation, but we're not seeing that trend decline. If inflation really started biting, we'd probably start seeing July kind of trend down versus June, for example. But we're not actually seeing that yet. Instead, consumers are holding up, and one of the reasons for this could potentially be lower gas prices. See, one of the fascinating things about gas prices is we are now experiencing a reversal of something that has been very, very damaging to the consumer, yet consumers still held through that. Now, I know that gas prices have gone up from like a national average of like $2 to $4, so we're still at a double. Even though we're down from 5, we're still way higher than where we were, right? But the trend of gas prices going down is very important because of this chart right here. This particular item here, this note from a JPM research report tells us that consumers spend $1.60 less for every gas dollar that gas goes up. So let's make that crystal clear because it's so important and you should screenshot it to remember it, okay? For every $1 that gas goes up, consumer spend goes down by $1.60. Well, now reverse that trend. If gas goes down by $1, then consumer spend actually potentially goes up by $1.60. That's actually a very, very good thing that could give us tailwinds to consumers actually holding on to spending or potentially spending more going into the second half of the year versus the thesis that course member Steve this morning brought up. Course member Steve this morning in our Market Open live stream video where we covered consumer sentiment numbers live together and went through some earnings together and fundamental analysis, Steve mentioned, hey, there's this potential that in the second half of the year, we're actually going to see consumer spending while it held up in the first half plummet because this was really the first summer where we haven't seen COVID restrictions. And Steve's right. Like he's 100% right. This has been the real first clear summer where people are like, let's go. We're tired of being inside. I've been inside for 2 years. I mean, I was a victim of this. I feel like myself. I feel like I was inside for 2 years minus the campaign last year. I feel like I was inside for 2 years and gained like 45 pounds. So it was like COVID 20 times 2.5. It was terrible. Anyway, I'm really glad to get back out there and like lose weight and anyway, be normal again. But anyway, what's interesting is that this fact about gas prices could potentially actually help us maintain that consumer spend throughout the rest of the year. And we've got some really important data here to cover. Look at some of these charts. So the first thing that we're noticing is the daily spend, card spending per household. When you exclude gas and grocery prices, is charted right here. Now, what's really incredible about this chart is it shows us that, wait a second, consumer spending after July's low is actually rotating up. And this is excluding gas and groceries, right? But if you consider the fact that gas prices have gone down over the past month, it actually makes sense that, oh, look at that. As gas prices have gone down, consumer spending is going up. in line with the research that for every dollar gas prices go down, consumer spending could go up by $1.60. This is actually a really good trend and potentially suggests that consumer spending could be strong going into the second half of the year, but it's something that we want to pay attention to, and it's something that we research regularly. Now keep in mind, if you want to be part of the course member live streams where we cover things just as an example, like this Toast earnings call, you can do so using that coupon code expiring on August 19th. Make sure to take advantage of that and get inside. You get lifetime access. You pay once and that's it. And then you're in. Not only do you get lifetime access for these programs on building your wealth, whether it's getting into real estate or stocks, but you get somebody who actually does both stocks and real estate, which is pretty rare, daily looking at fundamentals, whether it's real estate or stocks, and answering your questions directly, as well as the recorded lectures that we have, buy sell alerts in the stocks group, fundamental analysis in the property management, do-it-yourself rental renovations or real estate courses, and more. So check them out. Link down below. There's a coupon code that expires August 19th. But take a look at this. Toast, which is a credit card processing company or payment processing company, a terminal, essentially a terminal platform for use at restaurants. They tell us, or at least their CEO tells us, that they have not seen any pullback in consumer demand yet. Now, there's a lot more that we talked about regarding Toast, including some of their fundamentals, which we'll skip for the purposes of this. But what's really incredible here is the consumer is holding up. Take a look at some more information that we have right here. The consumer, while they're spending less money overall and they're still growing their spending, look at this. This shows you that online spending popped during Amazon's Prime Day, and it's actually now positive still after Prime Day, despite being negative year over year for online spending between March and essentially the beginning of July. That's fascinating because this right here was really our recessionary period, right? This is where everybody's like, that's it, we're going to heck. And online spending actually had negative year over year growth, whereas total spending still had positive year over year growth. But that's now moved to positive. Even after Prime Day, it's still positive. We're also seeing an uptick in leisure spending, which is very incredible. We are seeing median household savings and checking account balances still well above where they were in 2019. Look at this, folks. That right here was 2019. Look at this. This is where we sit now. Sure, it's not as high as what we saw over here in 2021, but for all income groups, consumer savings are higher. Now they're slightly trending down, but we're still at 1.4 times essentially what we were in 2019. This is actually a good thing. And on top of that, median household savings and checking account balances by age group are also all higher than where they were in 2019. Every age group and every income group is seeing higher account balances, and as gas prices go down, they're expected to spend more money. Now, we are seeing credit utilization go up, and this has led to a lot of folks saying, uh-oh, Kevin, credit utilization is going up. People are taking on more debt. This is dangerous. Maybe, but look at this. Take the under $50,000 of income demographic. You're still lower by 4 basis points, actually 4% rather. You're still 4% lower in credit utilization than where you were in 2016, or really at least 2 to 3% lower than where you were on the average between 2016 to 2020. And this is the same is true for all of the different income demographics here, which is again incredible. Now, some people say, but wait a minute, Kevin, wait a minute. Total consumer loans outstanding are at a record high. And this is true, they are. In fact, you could see total consumer debt outstanding peaked around the beginning Q1 of 2020. But we've actually peaked past that now. We're at the highest levels of consumer loans outstanding right now. And that's leading to concerns that that's it. We're just waiting for defaults. But wait a minute. We just saw that consumer balances of savings are higher, checking account and savings balances are higher. And so when we look at this chart and we look at debt as a percentage of disposable income, that is the money people have to spend to service their debt, what is that as a percentage of their income? So if your income's $100 and you have $10 of debt payments, your, let's say if you have $100 of leftover disposable income, which just means you have money that you could spend on whatever the heck you want, and then you have $10 of debt payments, you would have, this percentage would be 10%, right? The average right now sits around 5.6%. And what's crazy is it's well below what we saw during the dot-com bubble. It's below what we saw going into the 2008 recession. And it's even below what we saw going into the pandemic. So yeah, consumer lending is going up, but people have more money and more capability to service this. So this is actually quite bullish. And in my opinion, gives us some credence to this argument that we might not see that summer cliff of spending plummeting. Now, it's possible that back to school spending led to a surge of certainly online spending in July, and maybe we'll go back to negative online spending growth year over year towards the second half. But overall spending might continue to be above 0%. We'll see. But even Toast telling us that even at restaurants, they're not seeing any indication of slowing consumer spending. I think so far, looking pretty good that the consumer might actually stay strong throughout the rest of the year. And in my opinion, that's really, really bullish. This is potentially one of the best recessions ever. It's incredible. And that also gives us insight into this following chart, which is something that the Federal Reserve really pays attention to. And it's this right here. It has to do with inflation expectations. So this is the Consumer Sentiment Survey from the University of Michigan. We were expecting the longer term inflation expectation to go down from 2.9% down to 2.8. It actually came in at 3%, which is slightly bad news because it means that expectation for consumers in the long term for inflation went up by about 0.1%. Not great. However, the 1-year inflation target, which was expected to come in at 5%, came in soft or it was expected to come in at 5.1%. It came in at 5%, and the previous was 5.2. So what does this mean is we really just got a mixed report here that suggests, hey, consumer expectations for inflation are actually quite stable. And if anything, consumer sentiment improved, coming in at a read of 55.1 versus 52.5 expected. So consumer sentiment beat and is improving, and inflation expectations are still relatively stable, which is one of the most important things that the Federal Reserve looks at. What are inflation expectations and how are they changing over time? The biggest risk to our market is de-anchoring inflation expectations, because when inflation expectations go to the moon like they did in the 70s, then Paul Volcker comes out, raises interest rates to the moon, and really crushes our economy. That's not what we're seeing right now. In fact, if anything, what we're seeing right now is good news is finally becoming good news or bullish. The news that earnings are coming in strong is supporting this bull market rally we're seeing. The news that a consumer sentiment survey is coming in stable and consumer spending is holding strong is being seen as good rather than bad, because we're coupling consumer spending staying strong and earnings staying strong with inflation finally inflecting down, which is what the bond market has been predicting for the past 4 months, and we've been covering on this channel, pointing to September, August and September as very important months for inflation inflecting down. And that's what we started seeing. So folks, personally, I think this is great. I think this is great news and explains why we're seeing the market today decently green. Now, while the market tends to be quite volatile, take a look at this QQQ chart here. We've gone from, nearly flat to up about 1% on the NASDAQ, and we've been bobbing around. Tesla's been bobbing around between plus 0.5% and minus 0.5%. Overall, markets appear relatively enthused that, hey, the consumer's still strong, consumer sentiment and its expectations for inflation are stable. And in my opinion, this could be a longer term sign that this bottom is in for stocks. Now, I don't want to say that we don't have a chance of retracing back to the 318 line for QQQ or even the 299 line by having a retracement back to some of these other support levels. But I just don't see the catalysts of uncertainty that would drag us all the way back to what we saw in June or July, which was the NASDAQ somewhere around 268, which was pretty dang low. These are my thoughts. Let me know what you think in the comments down below. Check out Seeking Alpha via the link down below and use that coupon code before August 19th and get the best price today. Thanks so much. Bye.